Hello and welcome to another Market Chameleon tutorial, and today we're going to go over Debit Long Call Spread screener. This is different, the opposite. I wouldn't call it the opposite, but different from what we did yesterday, which is a put credit spread. Now we're doing a debit call spread where you're paying an amount, but based on history and Market Chameleon's edge, you are going to find some opportunities to pay less than what you should have. And if this is a little complex, I'm going to go over this in a minute with you. But before we do, let's read the disclaimer and know that this is not a financial advice. I'm not a financial advisor. This is for entertainment, educational purposes only. And my name is Ziv, also known as Finance After 40 and Market Chameleon. If you're not a member just yet, 7 days trial, link in the description below. So, from the video yesterday, we did, if you go to screeners, yesterday we did this, bull put spread, put credit spread, and today we're doing the, I wouldn't say opposite, but it kind of opposite, bull call spread debit. Okay, so let's click here. And let's read real quick. It says debit long call spread involve you buy. This is what you need to, what's going on. You are buying call options for an expiration, okay, and selling the same number of call option, the expiration, the higher price. So in the opposite of the put credit spread, okay, that you generate credit, here you are paying a debit, but the goal is to pay less debit. You're basically buying one call. Okay, that's what you do. You buy the call that is closer to the underlying stock, and you sell another call at the higher price, thus the debit instead of the credit. So step one, you buy call close to the strike price, and then so you pay money for that. You pay a debit. But to offset that debit by a little bit, not by the whole thing, you are selling a call at the higher your goal is to be above the call that you sold. If the price goes above the call that you sold, you are making the max amount of profit, which is defined by the spread as well. So let's go over some details. So you see here, and of course you can read, use the filter and all that stuff, but all those filters, if you got the Market Chameleon, let's do, for example, because it's a call debit spread, I don't really use the theoretical edge, I use the win rate. But just so you see, if you go here, next 30 days, maximum $5, any return, dividend, all that stuff, and I want to play the earnings. That's why I don't change the earnings, because I would like to see maybe there's some trade ideas. If the stock pops, then my call credit spread, debit spread will make bank. Any positive above 70%, and let's see what we got. So I'm going to show you two things, but then I'm going to show you the win rate. I like to play by win rate because this is a debit. So for debit I play the win rate. If this was a put credit spread like the tutorial from yesterday, I would use the edge, because if you use the edge, you get paid the most amount of income based on history. So all this is more income. All this is more income on the credit, but on the debit, it's different. On the debit, you are paying less. Okay, the theoretical edge means you are paying less. For example, for this one, I don't know the stock, NVO, okay, 600 billion market cap, good to know. You are basically the debit, you are paying $225 compared to $308. This is your edge. However, I'm not doing the trade, I'm just telling you what you need to look for. Price for this one, for example, $138, and the trade itself is for September 20, for example, and you buy the 136, okay, which is already in the money, and you sell the 140. And your goal is basically to go above 140. So if the stock goes above 140, this is your max profit, okay? And you have until September 20 to do so. That's it. Now this one, for example, same thing. If you look just on edge itself, you are paying less. You're paying less. Again, completely different than the put credit spread from yesterday, where the edge gave you more credit. Here the edge tells you that you can pay less than what you should have paid based on history. So here you pay 65 compared to 88. Let's find something that I know. For example, Shopify. Okay, so the price 73 bucks. Okay, 94 billion market cap. Let's see what this one. You are paying $227 in debit compared to 296, 30% edge, 72% win rate, and the trade itself, you buy the call 71 and you sell the call 75, and as long as by expiration 27 of September, and as long as Shopify stays above 75, okay, they need to go a little higher, above 75, you are collecting you are making the money that you should have made. And it tells you here the max gain is $173 is what you are making for risking 227 compared to risking 296. Okay, let's go over a few more examples. Avago, for example, 160 bucks, and you're paying the debit 290 compared to 395. And this is a trade that basically it says buy the 155 the calls for September 30, but it says earning is September 5. So you're already in the money, but the problem is that there are earnings, and your max gain, which is right now, if it expires today, is $210. So your max income, your max profit is 210 while risking 290 compared to 375. Let's go over PayPal just real quick, and then we're gonna change to win rate. So PayPal 72 bucks, almost 71.86. You pay the debit 280 compared to 360, and the trade itself buy the 69, sell the 74 for September 27. And if PayPal is above 74, your max profit is $219. And your max risk is 280. So this is just if you go by edge, where you pay a lot less than what you should have paid based on history. This is what Market Chameleon shines for. Now the next option is to go by win rate. If you go here, let's click twice. Okay, so because this is a debit, I prefer to go by win rate instead of by edge. The edge, I like to collect more income, so I use this for put credit spread. So let's see, for example, 94% XLI, I think it's ETF, I'm not sure. Let's click Industrial Select. Okay, so Industrial Select Sector Spider ETF. So the price is 130, and you see here, there's no edge. You pay the debit 380 compared to 382 based on history, but you're getting 94.4% win rate. And trade itself, you buy the 122, you sell the 126. There's no earnings, it's an ETF, there's no big events, and as long as the price stays above 126, your max profit is 20 bucks. Okay, that's what it is. I mean, it's not a lot. Maybe if you do 10 trades, it's different. You collect 200 bucks, but your risk is like 380 times 10. So it's not a trade that I would do. So let's see something maybe like a combination. Here's a combination: 50% edge, 91.7% win rate. Let's see what it is. DXJ, is this the Dow Jones or something? Wisdom Tree, Japan, hedge equity. It's probably Japan ETF. I don't know what it is. 107 price. I'm not touching it. I'm just giving you some trade opportunities, thinking based on history what you could have done. So the price is 107, just so you can understand what is a debit call spread. Price 107, let's see what it says. So you buy the 103, you sell the 106. Remember, we are at 107, and you're paying $240 debit compared to 276. So there's a little edge, 15% edge, 91% win rate, and your max profit is 60 bucks. While risking 240. It's up to you. And all the rest you see here, 2%, 1%. There's not a lot of edge, but the win rate is high. So Boeing, for example, 172. You see, the debit is 465 compared to 475. Basically, almost the same based on history. 2% edge, okay. 89% win rate. So remember, buying at 172 and the debit call spread is 157.5, 162.5. So Boeing needs to drop 10 points by September 13, and you're still collecting the max profit, which is $35, but you're risking 465. That's why, for me, I prefer the credit spread for income. But a lot of people like to do this based on earnings. That's another thing that you can filter. Maybe do a earning date before expiration if you wanna go like on the risky side. Not saying to do that. I'm just saying if you look at all the earnings and then go by theoretical edge and then the other one. Let's see what we got here. Something that I know, Avago, same thing. Yeah, we already talked about it. As long as it's up to you. We can do the win rate. It's really up to you. Yeah, same thing. Kruger at 52 and 47.51. Again, it's all earnings. So this is a lot of people like to do like a debit call spread on the big guys, on the Tesla, before the splits, on the Shopify before the split, on Microsystem before the split. The stock that were like 600, 2000, Amazon back in the day when before the split, 2000. All those stocks that had like 4-figure price tag, instead of just buying calls, a lot of retail did basically a debit spread, hope and pray that the price will go up post earnings, something like that. But if you do use Market Chameleon, you can use it either for win rate, theoretical edge. I myself, while I like to know what a call debit spread is, I prefer, and this is just my personal preferences, to do the put credit spread for income. I prefer to use the edge for income instead of using the edge to pay less for debit. That's just me, my preferences. But this is a tutorial to learn how to do a debit call spread and use Market Chameleon. Hope this was helpful. 7 days trial, link in the description. See you next time. Yeah.